Let's examine some basic but important concepts of trading for profit. Trading for profit is defined as taking a controlled risk in order to profit more than you lose. Every successful trading tactic involves losing, which is part of every successful trader's career. According to the celebrated risk and probability researcher Nassim Taleb, in his book Black Swan, you cannot predict anything in nature with great accuracy because every time in the past there have been many forces involved that remain unknown to you. Thus, you cannot have successful trades all the time. It certainly isn't possible or necessary. It is very important to accept this hard fact. You don't care about losses. You only care that your profits are bigger than your losses. When you are wrong, control your loss by using a predetermined stop. When you are right, let your profits soar as long as your parameters for staying in a position are valid. It really is that simple. Allow me to give you one good example. We all know about roulette game. There are 18 black and 18 red number pockets on a roulette wheel. If you put your bet on black, you will have an equal chance to lose and win. If you spin the wheel over the course of many rounds, your outcome will probably be close to zero. That's because you and the roulette operator have the same chances of a win. But there is one tinier slot on the wheel, green 0. If your ball ends on a green, you will lose the bet. It is this tiny 37th pocket on the wheel that constantly guarantees casinos hundreds of millions in profits, meaning they never lose money in the long run. As they have only a 2.7 statistical probability advantage over you as a gambler, they will always end up as the winner in the long term. Contrary to popular belief, casino business models have nothing to do with luck because their probabilities can be calculated in advance. All they have to do is stick to their proven tactics and patiently wait for their advantage to materialize. Thus are the same tactics that you will need in order to profit on the Forex market. In trading, probability is more important than prediction. You will learn how to build profitable tactics which put you in an advantageous position over the market, and you will patiently wait for these tactics to make you profit. Just like a casino operator, you will not care about single trade outcomes. You will spread risk across many trades and let probability materialize. Your only concern will be the total outcome. This is easier said than done because you will need to arm yourself with discipline and patience, which is not an easy task for some people. It depends on you, your motivations, and your desire to succeed in this business. As you probably realized thus far, success in trading has more to do with disciplined, systematic, and safe approaches than with some heroic fighting, me against the world approach. You don't trade against the market or against other traders, as it is often wrongly supposed. You just sit on the sidelines, watching others fight each other and trying to spot safe bet situations where the odds to win are on your side. Then you jump in, place your bet, earn a profit and get out. Safe bets with a higher probability to win, that's all you should be concerned with. Actually, there is nothing heroic in this approach. We humans love heroes and shrewd human actions, but in this business, heroism is a sure path to bankruptcy. Anyway, having discipline and patience is a highly respected virtue, on a par with heroism. In trading, you don't think, predict, or have an opinion. You just react based on what you see on the chart. To summarize this section, let's say that you need to devise a profitable tactic, stick to it, and patiently wait for the law of probability to work things out in your favor. In the end, you will earn more than you lose. In order to earn more than you would by simply exchanging one currency for another, you will usually use leverage. Leverage is the possibility in which to borrow and trade from 2 to 100 times more money than you have on deposit. By leveraging your deposit, you give yourself a chance to profit more from same price moves. Although leverage is a double-edged sword, and you may also lose more, we will learn how to avoid pitfalls and use it wisely. As a rule of thumb, the less leverage you use, the more chances you have to be profitable. That's why it is important to be realistic in setting profit goals. Gaining less profit is the more realistic goal. If you have a larger deposit, it is acceptable to gain a smaller percentage because gain will have a satisfactory dollar value. The problem is that traders with small deposits, hoping to gain a large percentage of profit, usually end up with the opposite outcome, that is, losing their entire deposit. It is advisable to use leverage from 3 to 1 to 10 to 1. Using greater leverage is riskier and will often involve counterproductive emotions during trading. One final word about leverage. Novices often ask, how is it possible for a bank or a broker to lend you such a big sum for trading purposes, without additional protection on their side? The answer is simple. They don't physically give you money. Money is still under their control. Their only risk is the currency rate difference at the closing time of your trade, which they will recoup from your deposit if you find yourself on the wrong side of the price move.